It seems like the market really digesting what Jay Powell said about needing more government aid in more of a negative tone here this morning. But it's not just the U.S. that perhaps need more stimulus. There's talks of additional spending in Europe, Japan, China. That's also died down as well. So how much more stimulus do risk assets need now?
Well, yeah, Yvonne, aside from monetary loosening, yeah, there's definitely a need for a bit more targeted fiscal stimulus. Speaking on China, I think given the increased tensions between the U.S. and China, China feels the need, right, to ramp up R&D in order to spur innovation in digital infrastructure. So going into the next 5 years, we are of the view that China will use tax waivers and a lot more policies to promote better R&D spending trends to catch up on the learning curve. And it's not just for semiconductors. For a lot of the technologies out there, they wanted to become more self-sufficient.
Yeah, speaking on that theme, Jefferies wrote a note saying that this is one of the best periods for Asian equities right now. You have this old school recovery of a weaker dollar, lower oil prices, and this whole digitalization theme that's playing out as well. Do you agree with that kind of view?
Yes, it's pretty much aligned with how the Chinese government is viewing this as well, because as opposed to the previous cycle when China would just pour in 4 trillion yuan on the traditional transport infrastructure, primarily high-speed rail, right? They have come out with a much broader scope of infrastructure these days, encompassing 7 aspects of primarily digital and innovative infrastructure. So 5G, AI, IoT, or even electric vehicles are included in that. So China is definitely using the next 5 years to really ramp up spending to invest in these areas.
Okay, Raymond, so you have that theme playing itself out. You also have a stronger yuan. To what extent is that going to foster more demand for Chinese assets, do you think?
Yeah, in general, like a flat to weaker dollar should be positive for emerging market equities. And we think that a stronger yuan definitely is not good for export-oriented names. And we have our eyes set on just the domestically oriented industries. So be it e-commerce and also digital infrastructure, as I alluded to, would be the 2 key sector focuses in my point of view.
Okay, and regionally, you are compelled to look at dividend plays, particularly dividend stocks, I should say. What are you looking to add in that space? What part of the region has some of the more attractive positions potentially for getting exposure to dividends? Yeah,
given interest rates are going to be low for longer, right? So we are of the view that like some of the sustainable dividend-paying stocks that are of good quality and leaders in some of the relatively stable industries, including consumer and telecommunications, they pay pretty good dividend yield in the range of like 5 to 6%, and so that creates a pretty positive spread versus the 10 years these days. So we are pretty constructive on some of the Singapore REITs and also some of the Hong Kong names that have been beaten down quite a bit of late. So we are primarily focused on the consumer REITs and telco plays in this regard.
Yeah, Raymond, so is it still better to focus on companies with strong balance sheets, with strong growth prospects, as you mentioned here? Is that better than trying to time a moving between cyclicals and defensive stocks?
Yeah, I think it has been a very popular question these days among investors, and we still of the view that assuming rates would stay low for longer, secular growth stocks should outperform in the medium to long term. But valuation has run its course, and so we are mindful of that. And we would recommend a balanced portfolio between secular growth stocks and also a good quality value cyclicals that should be well poised for recovery post this outbreak.
What would that entail, the cyclicals? Would you look into more of the financial names? What are some of the beaten down sectors that you're looking at?
Yeah, very selective on the financial side of things because many of us are aware of quite a few of the banks are still suspending their dividend payouts. And so we are more focused on the industries like insurance within financials or brokerage that are poised for more IPO activities here in the region. And they are more committed to continuing with their dividend payments. Aside from that, some of the REIT names in Singapore that are more leveraged to data centers and business parks would also benefit from a continuing need for digitalization, and they are much better positioned for growth there.